Hello and welcome to the trade. Before we get into the technicals, a quick look at what traders are watching and the likelihood of a US rate cut in September, now seen as a near certainty following the moderate US inflation data. Traders pricing a 99.9% chance of a 25 basis point cut, this according to the CME's FedWatch tool. It comes as US Treasury Secretary Mnuchin advocated for significant Fed easing, saying, "I think we could go into a series of rate cuts here, starting with a 50 basis point rate cut in September. If you look at any model, it suggests that we should probably be 150 or 175 basis points lower." President Trump has indicated he's close to nominating a replacement for Fed Chair Jay Powell, saying, "I think I'll name it a little bit early, the new chairman. I'm down to 3 or 4 names," he says. Meanwhile, the president has threatened severe consequences if Russian President Vladimir Putin doesn't agree to peace in Ukraine ahead of their meeting on Friday, but he hasn't revealed what those consequences would be. Let's get to the technicals. Peter Pan from ACY Securities joining me now. Good to see you. So what are we seeing on the greenback here amidst all of what I just mentioned and as we start to price towards Fed cuts, Peter?
So since August, the US dollar index has fallen steadily from 100 to 97.5. This is mainly due to the rising expectation for a September Fed rate cut. So in August, we both seen the weak non-farm payrolls and the lower than expected CPI this week, which has pushed the market focused for a 25 basis point cut in September from 50 last month to 93 currently. And at the same time, the Trump's nomination of Fed board members and a preparation for a successor list for the Fed chair has both raised doubt about the credibility of US data and the Fed independency. This has further boosted rate cut expectation and eroded the confidence in the dollar, which promoting overseas investors to cut back on US Treasury holdings. And with fewer foreign buyers, the prime dealers has been left to absorb the supplier, and which adds more pressure on the dollar. So in the short-term run, we expect the dollar to remain a downtrend. The decline of the US index is likely to be gradual, with choppy movements breaking below to 97 level and heading even lower. And over the long run, the US dollar depreciation could persist through Trump's presidency, driven by the structural change in US Treasury demand. This is tied to the balance between the current account deficit and the financial account surplus, which has showed in this chart. We can see it's very clear, like equal volume. The logic behind that is when Trump is pushing his like Great America and which want to give the pressure on the current account deficit, which will also give pressure on the financial account surplus, and this will create a much lower demand for the US bond from overseas, and also which will give pressure to the US dollar demand. So for longer run, we think the US dollar will still give more pressure during the structural trend. Structural trend in United States.
All right, Peter, what about what we're seeing with the yen relationship here, and I guess what the currency or the best trade is at the moment amid the Fed expectations?
Okay, so in short term, I think if you want to pair a strong currency against the weak dollar, I would favor the yen. So Japanese government bond has seen historical low demand during. It is because the Japanese wages is rising, the inflation is above target, and the rates remain low right now. And on top of that, the U.S. government would benefit from a stronger yen to reduce Japanese export. So these both reasons give the Japanese central bank a sentiment to hike the interest rate in October, so which will make the Japanese yen very strong and the US dollar yen very weak. So in my opinion, the current price for dollar yen is still overvalued and is likely to falling further. The strategy would be stay bearish if it break down like 146.6 or 146. After it breaking through this level, I will keep shorting it to 144 with the potential to even break lower.
All right. Well, of course, the other key focus for investors is really what's happening with gold. Peter, what are the technicals showing you?
So typically, a weaker dollar will support gold price. However, currently the price is remaining like range bound as the market is uh, is still recovering from the sharp rally from January to March. Uh, that price rise is mainly driven by the fear of Trump would impose high tariff on gold. However, in recent months, the traders has already realized that no matter how the tariff is going, the U.S. will never impose any tariff on gold, which has dragged the New York gold inventory keeps going down from April. So it has given much pressure on gold price and let gold not breaking through 3,400 for several attempts. But I still believe the weak of dollar will have strong support for the gold price in long run. But in short run, it will still be kept for the falling New York gold inventory. So there is like support and resistance right now. The outlook is that the gold price will be gradually going upward, but in quite a slow speed. I would favor buying on dip with the key support at 3,310 or 3,330. I would avoid to buy it when it break through 3,400 because it may be turning into a false technical break.
All right, Peter. Thanks as always, Peter Pan from ACY Securities. That does it for this edition of The Trade. Be sure to join us next.